This video was brought to you by the Slidebean Founders Edition. Get help from our team in your pitch deck, your financial models, and your fundraising. Sign up with the link in the description.
Almost every founder I talk to is thinking about their exit from nearly the beginning. Angel investors are frequently asking, what's your exit strategy? And at the seed and Series A stages, often founders talk about their exit strategy unprompted. I think that's a mistake. Early on, you should be focused on building a big and impactful company and dominating your market. Do that, and the right monetization event will come along. But from the beginning, it's important to understand how exits work and what possible outcomes may look like. Most first-time founders don't realize how, when, and why common exit scenarios unfold. So let's cover the primary ways an exit can occur, why and when they occur, and how to maximize exit opportunity value for you, your investors, and your team. All right, we have a lot of ground to cover. I want to talk about acquisitions, how companies are bought, not sold, acqui-hires, IPOs or SPACs, exit dynamics when bootstrapped versus venture-backed, some M&A deal terms to think about, and in acquisitions, where buyers are most likely to come from. Let's start off with an important statistic. With venture-backed companies, for startups that reach some form of monetization event, over 90% will be acquired and just a few will go public. So let's start by digging into acquisitions, how they work, and what to keep in mind. The first thing to know is the M&A mantra that companies are bought, not sold. But what does that mean? To maximize value for you, your team, and investors, the best deal you're going to get is when an acquirer starts pursuing you, aka you're being bought. They open up a dialogue along the lines of, we'd love to talk to you about possibly acquiring your company. The inverse of being bought is where you go out to sell your company. If you're a startup that wants to hire a banker and put a process together to sell your company, typically you won't get nearly the same premium. There is the blend if someone says they want to acquire you and you decide to then play the field and see if you can get other companies interested and get a bidding war going. If you can, that's great, as hopefully you'll get even better deal terms. But again, keep in mind that in the best case, startups are, for the most part, bought, not sold. The main time I see startups being sold is where it's some form of fire sale. Things are not working out, and the startup or investors are trying to recoup whatever cash they can and want to possibly find the team a new home. So since we said the best type of acquisition is when you're pursued, let's talk about where these buyers typically come from. Where do you find them, or where and how do they find you? We see that in most cases when a startup gets an acquisition offer, it comes from a company they already know and have some type of relationship with. Maybe it's a co-development partner, strategic funding source, integration partner, channel, or distribution partner. Often, they've worked with you for quite some time, see that you have something meaningful, and realize there's more potential if they own you. Sometimes you do get approached by someone you've never met before. It can happen, but it's rare. What's important to keep in mind if someone is talking to you about an acquisition is the deal dynamics will be completely different if you bootstrapped versus taking a lot of outside funding. With a lot of outside funding in your company, the more cash you take in, the fewer exit options you'll have. As you take in more investor cash, the exit hurdle grows substantially. Think about it. If you take in $1 million in outside funding, there are hundreds of companies that could acquire you in an amount that would provide a great return for founders and investors. But as you take in 10, 50, 100 million or more, there are fewer and fewer companies that can afford to acquire you and provide a return that venture investors and you would find materially interesting and provide a high ROI on funds invested. As a founder, remember that if a VC puts money into your startup, it's because investors want to back the next big thing, and they want you to go big or go home. Let's say you've raised $2 million from outside investors, and for that, they own 20% of your company. So you're probably at a $10 to $12 million post-money valuation. Someone comes along and wants to buy you for $10 million. Let's say you still own 30% of your startup and you do some very simple math, not remembering the exact terms of your deal, and think, awesome, I could walk away with $3 million. But your investor's thinking, I just put money in at that valuation, so I'm basically only getting my money back. For most investors, that's not interesting, as they're typically looking to make at least 3x or more in the very high-risk world of startup investing. I've seen investors on more than one occasion say something like, look, I think you shouldn't sell, but instead keep going. Build the company and let's make it into something huge. Remember, the more venture money you take in, the more options you take off the table for an early exit that may be meaningful to you, but not to others. Next up, I want to talk about a very common type of exit that many don't realize when it's happening, and that's the soft landing, rescue, or acqui-hire exit. When the startup has been going for some time, and usually after substantial investor funds have been consumed, but insufficient traction and market penetration have occurred, frequently startups or investors will start looking for a soft landing for the startup. This is for several reasons. The investors are looking to get at least some cash back out of the startup. The investor and founders are trying to find a home for their team so everyone has a job, and also everyone is trying to see if they can somehow monetize the IP and customer base. When you read the news of a startup being acquired and see the words "terms not disclosed," that's often a tell that a soft landing or acqui-hire has occurred. Usually not a great outcome, but look, it's part of being an entrepreneur and startup investor. Sometimes deals and companies don't work out, and you're trying to get the best possible outcome for everyone. A final note about being acquired before we talk about being a public company. If you get an acquisition offer, make sure to surround yourself with a great team of trusted advisors. Your board, investors, law firm, accounting firm, and hopefully other trusted entrepreneurs who have also been acquired. Structuring and hammering out a great deal is not easy and is a team sport. Most entrepreneurs don't have a lot of experience in M&A deals, and there are a ton of critical tricks and traps to navigating the due diligence process, earn-out agreements, deal structuring, price and consideration, tax consequences, escrows, holdbacks, reps and warranties, and dozens of more issues. Do your homework. Also, if you're VC-backed, suddenly your cap table and the terms of your capital stack are going to come into sharp focus as you figure out, with all of the preferences and rights, who exactly gets what. Bring your A team and your A game to this process. Okay, now the final type of startup exit to talk about is being a public company. Maybe you IPO, reverse merge into a public shell, or do a deal with a special purpose acquisition company or SPAC. Being a public company can be great, as it can, after a lockup period, provide liquidity to founders, investors, and early hires who have stock options. Being public does carry heavy administrative and organizational costs, and now you need to act a lot more buttoned up. As well, you can access very large pools of capital to continue fueling your growth. One other great impact is from a branding and marketing point of view. Being public adds a level of credibility to your company and brand awareness. Again, exiting by going public or being public happens infrequently to startups, as the M&A path is really most likely. I hope you found this overview of how startup exits work helpful. It's good info to keep in the back of your mind, and hopefully you'll get there one day. But remember, keep your eye on the prize, building a great company that dominates your industry. Do that, and the right exit opportunities will rise. I hope you liked this video, and if you did, please like and subscribe to both the Slidebean and Dream Adventures YouTube channels. Thanks for watching.